Halo semuanya, selamat datang di channel saya. Di sini kita akan membahas tuntas dunia bisnis dan strategi sukses. Jadi, pastikan Anda subscribe. Selanjutnya, silahkan menyimak materi dari rekan saya berikut ini.
Welcome to this explainer. Look, if you've been paying any attention to the digital economy in Indonesia lately, you know the tax landscape is going through a massive, highly structured evolution. Today, we're going to act as your guide through this complex, but honestly, absolutely fascinating web of Indonesian e-commerce tax regulations. We're taking the official decrees, the dense legalese, and the raw data and transforming them into actionable insights to show you exactly how the mechanics of this system actually work. Okay, let's map out exactly where we're headed today. We'll start with the base e-commerce tax rules, figure out the exact tax subjects and objects, look at the platform's role as a collector, break down the VAT and income tax rates, walk through the deposit and reporting mechanisms, and finally, touch on the administrative sanctions. All right, part one, the e-commerce tax rules, or what we like to call the regulatory umbrella. So this whole ecosystem, it's completely anchored by Ministry of Finance regulations. It's like a giant puzzle that started with the baseline PP80 back in 2019, folded in the VAT rules of PMK60 in 2022, got a broad unification under PMK81 for 2024, and now it all culminates in the unified operational mechanics introduced by the recent PMK37 for 2025. It's basically one giant unified netcast right over the entire digital marketplace. Moving on to part two. Tax subjects and objects. Basically, who and what is actually getting taxed. And wow, this tax net is wide. We are way past just buying a t-shirt online, right? The taxable objects literally cover the whole spectrum. We're talking domestic merchants selling physical goods, foreign platforms handling digital goods like software or multimedia, and even digital services. And yes, as mandated by the recent regulations, it explicitly targets crypto assets too. Basically, if digital value is being exchanged, you better believe it's firmly on the radar. Section 3 now, the platform's role as a collector. Think of this as the digital toll gate. You're going to see this acronym everywhere, PPMSC. It stands for Penyelenggara Perdagangan Melalui Sistem Elektronik. Essentially, it means the e-commerce platform operator. Under these rules, the government has officially deputized these platforms as tax collectors. So while you, the independent merchant, are the ones selling the goods, the platform is legally bound to act as a digital toll gate. They automatically intercept and collect the tax toll from the transaction before the cash ever hits your bank account. Pretty wild, right? But this brings up a huge question, especially for the smaller domestic merchants navigating this system. What if a micro, small, or medium enterprise, an MSME, is just getting off the ground? If their revenue is tiny, are they getting hit with these taxes right out of the gate? Well, PMK 37 for 2025 actually builds in a specific exemption for micro, small, and medium enterprises, or UMKMs. If a domestic merchant's gross circulation is under 500 million rupiah for the current tax year, they are totally exempt from this specific income tax withholding. But, and this is a massive but, it is absolutely not automatic. You have to actively submit a formal declaration letter to the platform to prove your revenue status. If you don't hand over that piece of paper, the platform is going to collect that tax, regardless of how small your shop is. Okay, let's get into part 4, VAT and income tax rate details. Time for the actual numbers and a quick case study. Starting with value-added tax, or PPN, the rules map out a very specific transition phase here. Right now, we're at the standard 11% rate that kicked in back in April 2022. But platforms and merchants need to be hyper-aware of the upcoming statutory shift to 12%, which is hard-coded into the Harmonization of Tax Regulations Law, or UUHPP. That digital toll gate we talked about, it has to apply these exact percentages flawlessly. And for the crypto crowd, the rules are super interesting. The final income tax rate, PPH Pausal 22, literally doubles depending on platform compliance. If the digital platform is an officially registered physical trader with Bapepti, the tax rate is a tiny 0.1%. But if they are not registered, boom, it jumps to 0.2%. It's a very clear, direct financial nudge from the state to get these platforms legitimized. Now, check out this defining number. For the vast majority of standard domestic e-commerce transactions, 0.5% is the magic number. That is the standard PP Pausal 22 income tax rate. The platform is going to skim exactly 0.5% right off the top of the domestic merchant's gross circulation. Done instantly. To put that into perspective, let's look at a real-world scenario straight from the regulations. Imagine two sellers on the exact same marketplace. Tuan WI makes an 8 million rupiah sale, but the platform collects zero tax. How? Because he was proactive and submitted his UMKM exemption letter. Then we have Nyonha NLG. She makes a much smaller sale, just 600,000 rupees, but because she completely forgot to submit her exemption letter, the marketplace is forced to automatically apply that 0.5% rate, collecting 3,000 rupees. It is literally all about having your compliance documentation in order. Which brings us to part 5, deposit and reporting mechanisms. Let's trace the compliance workflow. So the whole thing runs on this highly mechanical 4-step life cycle every single month. Step 1, the platform intercepts and collects the funds during the transaction. Step 2, they generate an official, unified proof of collection document. You'll hear this called Bukti Unifikasi. Step 3, the platform actually deposits that physical cash into the state treasury. And finally, step 4, they formally report the whole shebang to the tax authority using a unified tax return, known as the SPT Masa Unifikasi. And this creates a super strict monthly calendar. For the income tax, PIPIS 22, the deposits absolutely must hit the state coffers by the 15th of the following month, and the formal reporting has to be done by the 20th. Now, for value-added tax on digital goods, both the deposit and the report are due by the end of the following month. If a platform misses these rigid deadlines, the entire compliance ecosystem basically grinds to a halt. Finally, part 6, administrative sanctions. What happens when things go wrong? The legal texts under the General Provisions of Tax Procedures UU COOP outline some very real escalating consequences. If a platform drops the ball and fails to collect, deposit, or report accurately, the state isn't just handing out gentle warnings. We're talking standard administrative fines and compounding interest penalties. And if it's a severe case of ongoing noncompliance, the authorities hold the ultimate trump card. They can potentially revoke the platform's operational business license in Indonesia. Look, as Indonesia's digital economy matures, it's pretty clear the Wild West days are officially over. Grasping these precise mechanics isn't just about ticking a tax compliance box anymore. It is literally a fundamental requirement for business survival. So whether you're a scrappy startup merchant or a massive multinational platform, you really have to ask yourself, are you truly prepared and fully mapped for this highly regulated wave of e-commerce taxation? Thanks so much for joining me for this explainer, and I'll catch you next time.